All right, Marco Palmero, founder of Ulysses in Dubai. In this video, I want to discuss with you a quasi takeover we've been part of that didn't close, but it was kind of interesting because of some of the dynamics that we've been involved with here in the UAE and Middle East. So I'm going to share this personal story and this deal that we've been part of because I think it's going to be very, very interesting for us to explore. Now, we were in the process of working with a company that wanted to enter the UAE and Middle East market. And so we started providing them with DealFlow services and DealFlow sourcing services. And we built their pipeline of acquisitions and opportunities that they could potentially buy across UAE and Middle East. Now, what happened is that thanks to our network and our expertise in the market, we were able to receive some off-market opportunity that wouldn't necessarily be available to other people. And these opportunities were actually very good because we were talking about taking over a group of businesses, not simply as one small business or a single location type of facility. We're talking about a chain of businesses spreading across UAE and other regions. And so this was a very exciting deal, a very exciting opportunity. But after the opportunity got shared with us and we sat down with the management, nothing was shared to kind of like make us understand that the business was actually for sale. Now, what we came to realize after diving deeper into the analysis of the deal and talking with a lot of the people that we were in contact with in the region was that management wasn't necessarily interested in selling the assets because they were hired just a couple years before to fix the situation because these assets were not performing at a very high level. So they were substantially the guys hired to restructure the business, and it was in their own best interest to fix the situation because that's how they made their money, right? So dealing with management in structuring that particular deal was probably a no-go. And so we thought about a solution to potentially take over the business through the shareholders themselves. Since it was quite big, we could talk with shareholders who are not directly involved in the business and might not be part of management, but they might be the majority shareholders of the business. And the company was not quoted, so there was no need for us to look at the public market for that. We could talk with the guys who were the main guys one-on-one. Now, of course, that was a particular issue if you weren't aware who the shareholders were. But thanks to our network and our DealFlow system, we were able to identify these people fairly quickly. Now, as we sat down with them, we ultimately realized that the entire company was available for sale and that they were kind of distressed because they had a very complex situation with banks, right? So banks were calling on loans and the business was struggling to pay back those loans. So banks were looking for a way to repay that debt, and in the absence of it, the business might just declare bankruptcy, or the banks might foreclose on the business and just sell the assets by themselves. So long story short, the shareholder was looking for a way to solve this situation. And so we talked about the idea of taking over the business, or at least its shares, and then fix part of the situation with the bank and recover the business on our own. Now, as I mentioned, the discussion didn't progress to a point where the deal was actually consumed for a variety of reasons, which I'm not going to dive into in this particular video. What I think is interesting to discuss is this concept of partial off-style takeover that we tried. And I'm sure some of you might say, well, this is kind of like an unfair business practice. It's not correct to approach business this way. But the point is, hostile takeover are just part of business, right? They're just one of the instruments that companies can use to acquire assets and substantially buy stuff that they need. And if the shareholder was okay with that, it was a win for both sides, right? Because the shareholder was getting rid of a problem, we were getting the business we wanted. Management, of course, was in between, and that might have been an issue to deal with post-acquisition. But again, if management didn't have a saying in how the shares were sold, then that wasn't really their concern, and their opposition was not one of our problems. Now, of course, I'm talking about us, despite the fact we were working with a client on this, but it's because we were involved in the process, and so I thought about sharing this as a collective. The point I'm getting at is hostile takeovers are just part of business. I mean, you can Google hostile takeovers and you will see tons of hostile takeovers that happen worldwide, America, Europe, what have you. And they are a solution to get deals across, specifically when companies might not be in perfect financial conditions. Because in those situations, some people are going to be under pressure and they might have a high level of interest in getting rid of this problem. Another case that might happen that I've seen in America, for example, is where you go ahead and buy the debt of the banks and then you call on loans for the company. And that's a way to take over the business substantially. So if a bank has a loan with a company that hasn't been able to repay for a long period of time, you can go there to the bank, buy the debt for pennies on the dollars. You're solving a problem for the bank, and now you become the guy who needs to collect the payment from the business owners. In that particular case, you can call on loans and make sure you foreclose on the business or you take over the business if the owners aren't able to repay within a certain period of time. And that's another way you can perform a hostile takeover. I think from my perspective, I look at hostile takeovers as a solution to get what you need. Thankfully, when we look at our own small business acquisitions for Ulysses, we're never involved in hostile takeovers too much because we focus on profitable assets that generally are very straightforward deals that they're bought for multiple of EBITDA, and the deal structure is generally quite simple. But still, it was interesting to get involved in this particular transaction, even if it didn't close, because it taught me a lot about the processes of hostile takeovers and some of the dynamics that might happen in an hostile takeover. So I hope you find this video helpful, and I'll see you in the next one.